You hear it everywhere. ETFs are the modern marvel of investing. Simple, cheap, flexible, and perfect for beginners. Everyone tells you why you should invest in them better than a savings account, the smartest way to put your money to work. But here's the thing, while everyone is hyping up the why, hardly anyone talks about what you need to do before you even start. And that's a huge mistake. Just jumping into the first ETF savings plan you see is a recipe for disaster. There are crucial preparations you need to make first. There's essential knowledge that will shield you from rookie errors that could cost you a fortune and a lot of sleepless nights. So, in this video, we're going to walk through everything you need to know before you invest a single dollar in ETFs. Let's get started. First things first, let's talk about the boring stuff that actually matters most: your financial protection. Before we even think about returns and growth, we need to build a solid foundation. Imagine this. You start investing, you're super motivated, and over the years, you build up a nice portfolio. It's growing steadily. Then, the unexpected happens: a serious illness, an accident, or a liability claim that costs a fortune. Suddenly, you're forced to sell your entire portfolio because you urgently need cash. All your hard work gone in an instant. That's why the golden rule is: protection comes before building wealth. 3 types of protection are non-negotiable. First, health insurance. Most of us have it, which is great, but take a moment to double-check what your policy actually covers. Second, disability insurance. This is not the same as unemployment. If an illness or accident stops you from working, your income could vanish. Disability insurance can replace a part of that income, protecting you from financial ruin. And third, personal liability insurance. One costly mistake, and you could owe tens of thousands. This insurance is cheap, but absolutely essential. It might sound dry, but this is the bedrock. Only when these risks are covered does it make sense to start growing your money. Next up is your safety net, the emergency fund. Think of it as a financial cushion that catches you when life throws a curveball. Why is it so important? Simple. Without cash reserves, any unexpected cost: a car repair, a medical bill, forces you to either go into debt or raid your investment portfolio at the worst possible time. It's a financial disaster waiting to happen. So, how much do you need? A good rule of thumb is 3 to 6 months of your essential living expenses. If your monthly expenses are $2,000, you should have between $6,000 and $12,000 set aside. And this money needs to be liquid and easily accessible. Think a high-yield savings account, not locked away in investments. For example, if your car suddenly needs a $2,000 repair with an emergency fund, you just pay the bill and move on. Without one, you're selling your investments when the market is down or racking up high-interest credit card debt. Now, let's talk about how you invest. Many beginners make the mistake of only investing what's left over at the end of the month. If anything, that approach just doesn't work. The key to building real wealth is consistency. You need to set up an automated savings plan that invests a fixed amount for you every single month, like clockwork. Automation is the secret sauce that makes long-term success possible because it removes the need for willpower. How much should you invest? Ideally, aim for 10 to 20% of your net income. If you take home $2,500 a month, that's $250 to $500 going straight into your future. That might sound like a lot, but even small, consistent amounts grow into something massive over time. And if you think you can't afford it, take a hard look at your spending. You'll often find little leaks and used subscriptions, too much takeout, services you forgot you signed up for. Cutting just one or two of these can free up the cash you need to start investing in yourself. All right, you've got your financial protection and your emergency fund sorted. Now, you need a place to actually buy ETFs. This is where a brokerage account comes in. It's the essential tool for all your investments. But be careful, not all brokerage accounts are created equal. Some charge sky-high fees, while others are nearly free. Your regular bank might offer one, but they often have higher fees, especially for automated savings plans. Do your homework. Many online brokers offer free ETF savings plans. Compare the providers carefully. Every single dollar you save on fees is another dollar that stays in your pocket, compounding and working for you over the long run. So, what exactly is an ETF? It sounds modern and safe, but there's more to it than just 3 letters. ETF stands for Exchange Traded Fund. It's a fund that trades on a stock exchange, just like a single stock. This means you can buy and sell shares of it throughout the day. And because most ETFs are passively managed, meaning they just track a market index, they are way cheaper than actively managed funds. But here's the catch. Not all ETFs are the same. Some are incredibly narrow, tracking just a handful of companies in one specific sector. For example, a tech ETF might only hold 8 stocks. That's extremely risky. If that one sector takes a hit, your entire investment plummets. The true power of ETFs lies in broad diversification. With a single, well-chosen ETF, you can own small pieces of thousands of companies across dozens of countries and industries. That's how you properly reduce risk and participate in global economic growth. When you're ready to pick an ETF, don't just go by the name. You need to look under the hood. Here are the key criteria. First, costs measured by the total expense ratio, or TER. This is the annual fee. A good, broad global ETF shouldn't cost more than 0.2% per year. Many are even cheaper. Second, fund size. Bigger is generally better and safer. Aim for funds with at least $100 million in assets to avoid the risk of the fund being closed down. Third, the fund's age. Look for ETFs that have been around for at least 5 years. They have a proven track record. Also, decide if you want a reinvesting or distributing ETF. reinvesting, or thesaurizing. ETFs automatically put your dividends back into the fund to buy more shares, which is great for compounding. Distributing ETFs pay dividends out to you as cash. Finally, pay close attention to the index the ETF tracks. Broad global indices like the MSCI, CWI, or the FTSE All World are excellent choices for a core holding. Let's be clear, even though broadly diversified ETFs spread your risk, they are still made up of stocks. And stocks are volatile. Their value will go up and down. In a major crisis, the market can drop by 30, 40, or even 50%. History shows that markets have always recovered, but sometimes it takes years. This means you should only invest money that you won't need for at least 10 to 15 years. ETFs are not for short-term goals. You manage this risk through asset allocation, dividing your money between safe assets, like your emergency fund, and risky assets, like your stock ETFs. Research has shown that up to 90% of your long-term investment returns come from your asset allocation, not from picking the perfect ETF. This brings me to the most important mindset for success. Long-term thinking ETFs are not a short fling. They are a long-term relationship. History proves this again and again. After every crash, the dot-com bubble, the 2008 financial crisis, the pandemic crash, patient investors who stayed the course always came out ahead. But, as I said, it can take years. That's why your investment horizon must be long. If you can't commit to keeping your money invested for at least a decade, ETFs might not be right for you. Patience truly wins this game. Now, what about taxes? This is a topic that scares so many people away from investing. But in reality, for most people, it's surprisingly simple. If you invest through a domestic broker in your country, taxes are often handled automatically. When you earn dividends or sell for a profit, the broker typically deducts the required taxes for you. Often, all you need to do is set up your tax-free allowance with a simple form. One form, one time, and you're done. Don't let the fear of taxes paralyze you. So, let's put this all together into a practical to-do list. 1. Review your insurance coverage, health, liability, and disability. 2. Build your emergency fund of 3 to 6 months' expenses. 3. Decide on your monthly savings rate, aiming for 10 to 20% of your income. 4. Open a low-cost brokerage account. 5. Choose a broadly diversified, low-cost global ETF. 6. Set up your automated savings plan. 7. File any necessary tax allowance forms. 8. Review your plan once a year. 9. Stay patient. And 10. Stick with the plan no matter what. Let's look at a real-world example. Meet Anna. She's 28, earns $2,400 net per month, and wants to start investing. First, she checks her protection. Health and liability are covered, but she's missing disability insurance, so she gets a policy. Remember, investing isn't just about numbers. It's about psychology. When the market crashes and your $20,000 portfolio suddenly shows a balance of $12,000, panic is a natural reaction. Many people sell at this point, locking in their losses. But smart investors stay calm. They keep investing, buying more shares at a discount, and benefit massively when the market recovers. The truth is, the market is guaranteed to crash again. It's not a question of asterisk if asterisk, but asterisk when asterisk. Being mentally prepared for that moment will make all the difference. To wrap up, let's talk about the incredible power of compounding. It's your best friend in this journey. Imagine investing just $300 a month. Finally, ask yourself, why are you investing? Is it for a secure retirement, financial freedom, to travel the world? Having a clear why makes it so much easier to stay committed when things get boring or scary. Picture the life you want in 20 years and know that the simple steps you take today are what will make it a reality. ETFs are an incredibly powerful tool. They're not as complicated as they seem. You don't need to be a market genius. All you need is a solid foundation, a consistent plan, a good ETF, and patience. Once it's set up, your wealth can grow almost on autopilot. Time and consistency will do the heavy lifting for you, and that's the real beauty of it. Thanks for watching. If you found this helpful, please give it a thumbs up and consider subscribing for more content to help you build a better financial future. See you in the next video.